Investors are always looking for the next Apple, the next Google, the next Amazon, the next stock that could 10, 20, or even 100x in the next decade or so. The problem is, companies like Apple, Google, and Amazon are already very large, so they are unlikely to 10x again in the next 10 years. In addition, these companies are already popular in the investing community, which means that they are most probably richly valued. That's why we need to look harder. More specifically, we need to find companies that are still small or are now out of favor, because these types of stocks have the biggest chance of giving us multi-bagger returns. So today, I want to share with you one small cap stock and one out of favor stock that I think could deliver multi-bagger returns in the next 5 to 10 years. In fact, I think they can double in 2024. I made separate videos and articles on each of these stocks before, so if you're interested, I'll leave all the links in the description box below. And with that out of the way, let's talk about stock number 1, which is Sea Limited. So Sea Limited is a Southeast Asian tech conglomerate that operates 3 high-quality companies, namely Garena, which owns games like Free Fire and Call of Duty Mobile, Shopee, which is the largest e-commerce platform in Southeast Asia, and Sea Money, which is a fast-growing fintech company. The stock has been struggling as of late, down about 90% from its all-time highs, and is now basically trading at its COVID lows back in March 2020. So this got me interested, and after taking a closer look at the company, I think there's a lot to like about the stock at these prices. That said, the stock has been under a lot of pressure lately due to the fact that growth has slowed down significantly from triple-digit numbers in 2020 and 2021 to just mid-single-digit growth in the last 4 quarters. So years of growth has been pulled forward due to the pandemic, which consequently led to the company facing very tough year-over-year comps in the last couple of years, leading to the steep deceleration of growth as you can see right here. And as of Q3, the company has $3.3 billion of revenue, growing at just 5% year over year. So here you can see revenue by segment, and right away you can see that the digital entertainment segment, or Garena, has been dragging the entire business down with negative growth over the last few quarters. As of Q3, Garena revenue was $592 million, which is down 34% year over year due to lower monetization and engagement across its games. On the other hand, Shopee and Sea Money are still growing, although at a much slower rate than a few years ago, and this is reasonable given that they are growing over a much larger base. In Q3, Shopee revenue was $2.2 billion, up by 16% year over year, driven by a 5% increase in gross merchandise volume and a 14% increase in the number of orders. And I think that low GMV growth scared a lot of investors, especially with rising competition in Southeast Asia, including the recently announced merger between Tokopedia and TikTok, which could threaten Shopee's growth ambitions in Indonesia. And that is crucial because Indonesia is Shopee's largest market. That being said, notice how Shopee revenue grew faster than GMV growth, and this is mainly driven by Shopee's increasing ability to monetize its merchants and users, which is great to see. Finally, we have Sea Money, which generated $446 million of revenue in Q3, up by 37% year over year, as people in Southeast Asia adopt more fintech applications. And as you can see, this is the fastest growing segment among the 3, with the potential to overtake Garena in the next year or so. So the takeaway here is that the company's growth has been lagging, primarily due to Garena, which got many investors concluding that Sea's growth story might just be over. On the bright side, Garena Free Fire just relaunched in India, which should drive momentum in the business, and with continued robust growth for Shopee and Sea Money, I think Sea Limited will return to strong growth in 2024. Moving on, while growth has been lackluster, profitability seems to be trending in the right direction. As you can see, operating margin has been negative in previous years, but recently, the company turned GAAP operating profitability for 3 consecutive quarters as the company cut costs and gained operating leverage. However, operating margin turned negative again in Q3 to negative $128 million in Q3, which is a negative 4% operating margin due to higher sales and marketing expenses. So one thing I can take away from this is that Sea Limited has a choice. It can choose to be profitable or it can choose to be unprofitable, and in the most recent quarter, they choose to be unprofitable. Why? Because the company has completed its restructuring and optimizing process in the past 2 years, and now that the company is in a more profitable standing, management is choosing to reinvest into the company in an attempt to gain even more market share. So here you can see operating margin by segment, and as you can see, Garena margins remain stable, which is the dark blue line right here, and Sea Money margins are improving rapidly, which is the gray line right here. On the other hand, Shopee's operating margin, which is the light blue line, dipped from 3% in Q2 to negative 19% in Q3, and from this, it's safe to assume that management is taking all the profits from Garena and Sea Money and redirect them to Shopee to stimulate growth for the e-commerce segment. And this is intentional. They're doing it not because they have to, but because they want to grow Shopee. I mean, they could certainly choose to remain profitable, but instead, management chooses to sacrifice short-term profitability for long-term growth and market leadership, which I think is the right strategy moving forward, and I think it will pay off in the long run. Whatever it is, Sea Limited is in a good financial position to reinvest into growth with an operating cash flow of 600 million in Q3, representing an operating cash flow margin of 18%. And as you can see, the company has been cash flow positive for 4 quarters in a row, which is great to see, and this just goes to show that Sea Limited is capable of managing its capital efficiently. But here's the best part. Sea Limited by definition is trading at its lowest valuation multiple ever, despite being a much larger and more profitable company today compared to where it was 5 years ago. As you can see, the company trades at an EV to revenue multiple of just 1.5 times, which is a fraction of its high of 31 times and its average of 10 times. I think this is just ridiculous, and I think sentiment is just so bad right now that I think it pays to be a contrarian today. I mean, just look at analyst estimates. Expectations are just so low right now. As you can see, analysts estimate only a 2% growth in Q4, which I think is just too low. So I think the bar is just so low right now that Sea Limited don't even have to try hard to beat expectations. So I think Sea Limited is going to beat estimates in the upcoming earnings report, and when they do, I think we're going to see the stock ride higher from here. But that's not all. In the next few quarters and years, analysts are expecting Sea Limited's growth to re-accelerate to over 11%, and when the markets realize that the company is back to growth mode, I think Sea Limited stock would have re-rated higher. So I think it's a good idea to be a contrarian today and buy the stock when things are not looking so good. And based on my DCF model, I have a price target of $83 a share for Sea Limited, which is 111% upside from the current price of $39.57. So in short, I believe Sea stock is significantly undervalued and offers a decent upside. If you want more details on my DCF model, you can check out my article on Sea Limited, which I will leave the link in the description box below. On to the next stock, which is, surprise, surprise, Hims and Hers. If you're a long-time follower of this channel, you already know that I'm very bullish on this stock. And for those who are unaware, Hims and Hers is a telehealth company that provides patients access to personalized, affordable, and high-quality medical care. So one main reason why I'm bullish in Hims is that the company is growing very rapidly. As you can see, the company has consistently grown by 50% plus over the last 3 years, which shows how much people love its products and how well management has executed so far. Growth did slow down quite a bit in Q3, but this is expected as the company faced very tough year-over-year comps, and besides, no single company can grow 80 to 90% forever. Whatever it is, growth was driven by the company's expanding subscriber base, which was 1.4 million in Q3, up by 56% year-over-year. And the number of subscribers on a platform is important because it is a leading indicator of growth, and seeing such robust growth in the number of subscribers reflects strong growth potential for Hims and Hers. Because not only will these subscribers subscribe to One Health solution, which they do initially, but over time, these very same subscribers will eventually subscribe to additional categories which drive incremental revenue growth at minimal cost. And what if that 1.4 million subscriber base today grows to 5 million in 2 or 3 years' time? And what if each of them subscribe to at least 2 or 3 services under Hims and Hers? It's simple. Hims and Hers will gain exponential growth compounded over time, and as the company expands to new categories like testosterone boosters, insomnia, fertility, and even diabetes, the company's growth potential expands even more. And these are just generic drugs. What if they expand to multivitamins or fish oil or fitness supplements? Well, you can imagine how big the company's addressable market can be by just expanding to new categories, which is totally doable given the company's scale right now. In addition, Hims and Hers is expanding to more personalized multi-category treatments such as Heart Health by Hims, which supports erectile dysfunction and cardiovascular health simultaneously. Then there's MedMatch, which is a service that leverages AI and machine learning to identify the most optimal treatment for patients based on the company's extensive data set. I think one day Hims and Hers will be able to offer custom multi-category healthcare products on demand, which I think will be the ultimate key differentiator and growth driver for the company, which will eventually make Hims and Hers the one-stop shop for people's healthcare needs. Moving on, another reason why I'm bullish on Hims is that the company has very high gross margins. In Q3, gross profit was 187 million, representing a gross margin of 83%. And as you can see, gross margin has been improving over time, showing economies of scale within the business. So as an investor, this is what I love to see: strong growth and improving margins. In addition, Hims and Hers is on the verge of becoming GAAP net income profitable, with net margins improving over the last few quarters to -3% as of Q3. And when they do turn profitable, I think the markets will react positively on the news. In fact, we could see that happening as early as Q4, so this upcoming earnings season is going to be interesting for Hims and Hers. Regardless, one major reason why the company is not yet GAAP profitable is due to high marketing expenses, which grew 48% year-over-year to 116 million in Q3. As you can see, marketing expenses as a percentage of revenue, which is the dark blue line right here, has been over 50% plus over the last few quarters, which is really high. But technically, Hims and Hers could be GAAP profitable today if it cut marketing expenses completely, but profitability is not the main priority for management. Their key priority is maximizing subscriber growth, which requires high marketing expenses, and I think this is the right strategy moving forward because, again, subscriber growth is a leading indicator of future revenue growth. Besides, Hims and Hers can afford that high marketing spend since the company is already free cash flow positive. Bears always argue that the company's marketing expenses are too high and unsustainable, but as you can see, Hims and Hers is already free cash flow positive, and not only that, its free cash flow profile continues to improve with each passing quarter, with $22 million of free cash flow in Q3 at a 10% free cash flow margin, which is the highest that the company has registered so far. So clearly, the company is driving meaningful operating leverage despite the high marketing spend, which just goes to show that the company has a high quality and truly scalable business model. In terms of valuation, Hims trades at an EV to revenue multiple of just 1.5 times, which is ridiculously cheap for a company that has 50% plus growth, 80% plus gross margins, zero debt, massive growth potential, and turning profitable. Despite consistently strong performance and despite being a much stronger and larger company today, the stock is still down 60% from its all-time highs, which offers a great buying opportunity for investors today. As for me, I have a price target of $23 a share for Hims, which may seem overly optimistic, but if you read my article, you'll see that my DCF assumptions are very conservative. With that being said, this price target is nearly triple the current price of $8.83, and just like what I said in my Hims video, I think Hims and Hers is probably the most undervalued small cap growth stock today. Earnings season is coming, and with a perfect track record of beating analyst revenue estimates, I think the window of opportunity to buy him stock at this kind of valuation is closing very soon. So there you have it. These are two potential multi-bagger stocks that you can buy today. They are definitely risky companies to own, but I think the upside potential is very promising. If you don't like these two stocks, I have 3 more for you in this video, so definitely check that out. And as always, thank you for watching this video. I appreciate you and I hope you have an amazing day. See you guys on the next one.